Literature related to entry barriers as components of market power.
Another variable is the height of the entry barriers, which consequently has an impact on the concentration index. Rumelt separates tangible and intangible entry barriers, demonstrating that tangible entry barriers have less impact than intangible entry barriers. Tangible entry barriers are used by Densetz, who views absolute or relative firm size as an entry barrier, related to efficiency and innovation. In contrast, Sheperd, 51, Gale, 52 and Bothwell use market share. The financial situation of competitors also has an impact on entry barriers. Stigler, 53, Fisher, 54 and Hall, 55 use risk differentials to incorporate three risks: return volatility, financial leverage, and non-diversifiable risk. Bothwell uses leverage, profit variability, and non-diversifiable risk, beta. Higher risks generate higher returns. Economies of scale is another important entry barrier. Bain uses the formula of capital output equals book value of assets, sales. Bothwell uses scale economies and absolute capital requirement, assets/sales. Holterman postulates that the entry barrier equals size of the plant and that the height of entry barriers depends on the plant's size and advertising. Intangible entry barriers are also used by Bain, such as producer consumer goods, as a dummy variable to incorporate differentiation. Bothwell and Holterman use advertising intensity with ad expenses. Kuminer and Schmale NZ use ad expenses as a proxy of product differentiation. Schmale NZ developed a sophisticated model that explains the relationship between advertising and monopolies. Advertising may invite new entrants to enjoy friendly customers. The impact of entry barriers on margins is a matter of dispute. For Bothwell, market share correlates with margin where firm size is a barrier to entry. Schmale NZ, however, arrives to the opposite conclusion, wherein market share barely has an impact on profits. Bothwell concludes that advertising correlates with margin. Bain disagrees and believes advertising and margin correlate because high differentiation increases high monopoly, and consequently high ad expenses are justified because they drive high margins. Growth is another element that seems to correlate with entry barriers and margins, according to Rhodes and Cleaver. Bothwell demonstrates that Bain was wrong. Risk premium does not correlate with margin. For Bothwell, companies do not collude. The entry barriers of firm size and risk premium do not impact margins. The impact of knowledge as an entry barrier is also a matter of debate. For Rumelt, knowledge always makes sense. Diversification is based on economies of scope, idiosyncratic investments, and uncertain inimitability. Companies between 1949 and 1974 that diversified grew from 30% to 63%. This growth mostly occurred when these companies remained in related business, K matters. Densetz shows that efficiency and innovativeness are both linked to knowledge and impact on profits. In summary, the literature identifies several components of market power, such as concentration, firm size, advertising, knowledge, growth, and others. However, there is not an index of market power as such.